Welcome to The Explainer. So, have you looked at your investment portfolio lately and just felt stuck? Like you're running on a treadmill, putting in all this effort, but you're not actually going anywhere? Well, you're not alone. Today, we are going to break down exactly why the market has slammed on the brakes. And trust me, it's a wild story that connects Washington, Moscow, and Mumbai in ways you'd never expect. All right, here's the game plan. First, we'll tackle the problem everyone's feeling, those zero returns. Then, we're going to trace it all back to the global events that kicked this whole thing off. We'll get into the huge fight over the US dollar, see how all that chaos lands right on India's doorstep, and then, this is the important part, we'll build a real, practical playbook you can use to navigate all this madness. Okay, let's just dive right in. We're starting with that one big, nagging question that so many of us investors in India are asking right now. And it's a question that stings a little more, because let's be honest, we just came off one of the most incredible periods of growth we've ever seen. I mean, just think back for a second. From 2022 to early 2024, it felt like you could do no wrong. The market was on fire, an absolute historic bull run. Money was just flooding in from everywhere, and our portfolios were looking pretty great. There was this real sense of, optimism. And then, poof, it felt like someone just yanked the plug. The music just stopped, the momentum vanished, and everyone's kind of looking around going, wait, what just happened? That's it, a big, fat zero. After all that momentum, all that growth, the net result over the last year is nothing. Zilch, nada. And this isn't just a little slowdown, folks. This is a dead stop. So the real question is, why? This isn't just random market noise. No, this is the result of a global chain reaction. And our job today is to follow those dominoes as they fall, one by one. So to find the reason why the Indian market stalled, we've actually got to look thousands of miles away. This whole story really kicks off on the world stage with one very powerful and, let's say, very blunt economic weapon. Around September of 2024, the first big shockwave hit the system. The US, under Donald Trump, started getting really aggressive with tariffs. Now, there's a reason Warren Buffett once called this an act of war. Think of global trade like this incredibly complex, finely tuned machine. When you suddenly jam a wrench, like a tariff, into the gears, the whole thing starts to shake and sputter and just break down. And that's pretty much what happened. And this just perfectly shows the domino effect. The big foreign institutional investors, the FIIs who manage these massive funds, they hate one thing above all else: volatility. Their entire job is stability. Tariffs are the exact opposite of that. So what do? They did what they always do in a crisis. They hit the big red eject button. They pulled billions out of markets they suddenly saw as risky, like ours here in India, and they ran for cover in traditional safe havens like gold and government bonds. But hang on, why would the US risk causing all this chaos? I mean, what problem could possibly be so big that it's worth shaking the entire global system to its core? Well, the answer lies in this absolutely mind-boggling number that they're wrestling with back home. $30 trillion. That's the US national debt. It's a number so huge, it's almost impossible to really wrap your head around it. And it's been quietly piling up for years, like this silent crisis just building and building in the background of the world economy. Now, this slide, this is what really puts it all into perspective. That $30 trillion, it's more than 7 times the size of India's entire economy for a whole year. So you can see, managing this mountain of debt isn't just some policy debate for the US, it's a matter of economic survival. For decades, America has had this incredible superpower to deal with its debt. They can just print more money, and they can get away with it because the US dollar is the world's reserve currency. Oil, trade, you name it, it's all done in dollars. Everybody needs dollars. But that superpower is now under direct attack. Countries like China and Russia are just tired of a system they feel is being used against them. They're actively trying to de-dollarize the world. By creating their own currency for trade, the BRICS nations are trying to build a whole new financial system, one that doesn't rely on the dollar. And think about it. If even just 10% of world trade moves away from the dollar, that superpower to just print money starts to fade. And what some people call a house of cards economy starts to look really, really shaky. This is the existential threat that's pushing America to make these aggressive moves. Okay, so let's bring this all back home. How does this giant geopolitical chess match between superpowers actually affect us here in India? And more importantly, your investments? So here's the fascinating part. The tariffs that hit India, they weren't really about India. We just got caught in the crossfire. The official reason was that we were buying discounted Russian oil, but the real play was to squeeze America's main rivals, Russia and China. India just happened to be a very useful pawn in that much bigger game. But India wasn't just sitting there taking it. No, India was being incredibly opportunistic. Just look at this chart. Before 2022, the huge Jamnagar refinery got only about 5% of its crude oil from Russia. Today, a massive 50%. India started buying up sanctioned Russian oil on the cheap, refining it, and then selling the finished products like diesel back to Europe and even Ukraine for a huge profit. We're talking 94,000 crores. It's a perfect example of how in today's world, countries act like giant corporations, and this is all just a high-stakes business war. Now back home, the Indian government saw the economy was sputtering and tried everything to get it going again. They pulled all the levers. First, they cut income tax, hoping we'd all go out and spend more. But people got nervous and saved the money instead. Then they lowered interest rates to get companies to invest in new projects, what we call private capex. But businesses were spooked by the global chaos. I mean, why build a new factory when you don't know who you'll be selling to next year? Finally, they cut the GST. Each move made sense on its own, but the global storm was just too strong to fight against. So this brings us to the million-dollar question, right? If the overall market is giving us a big fat zero, how on earth are some investors still up over 20%? It's not magic, and it's not about perfectly timing the market. It's about knowing where to look. It's a strategy called sector rotation. Okay, the key insight here is really simple. If all the trouble is coming from US-centric geopolitics, then the smartest move is to shift your money into parts of the Indian economy that are walled off from that specific storm, right? I mean, think about it. Hospitals serve a domestic need. Telecom is a local issue. Defense is funded by our own budget. And things like alcohol, cars, and real estate are driven by what we do here in India, not by what happens in Washington. It's like moving your boat from the stormy open seas into a calm, protected harbor. All right, let's get even more practical. Sector rotation tells you what to look for, but you also need to know when to make your moves. And for that, there's a simple but really powerful rule that can be your guide for managing risk as it happens. Let's talk about the 200-day moving average, the 200 DMA. Now, this isn't some super complex, secret financial indicator. It's really simple. It's just the average closing price of an index, like the Nifty, over the last 200 days. Its real power is that it smooths out all the day-to-day noise and shows you the true underlying long-term trend of the market. It's what all the big players are watching. The strategy here is to let the chart make the decision for you. It takes the emotion out of it. When the Nifty is trading above its 200 DMA, that's the market telling you it's healthy. It's in a long-term uptrend. That's your green light. But when it breaks down below that line, that's a huge red flag. It's the market signaling that the trend is turned negative and it's time to stop playing offense and start playing defense. And this is what playing defense looks like. When the Nifty broke below its 200 DMA back in January of 2025, a smart move would have been to shift from being all in on stocks to something like this. 50% in equities? Sure, but also 25% in gold and 25% in cash. And why? Well, studies show that in times like these, gold actually beats stocks 8 out of 10 times. And that cash? That's your dry powder, ready to deploy and buy back into the market when things are cheaper and the trend turns positive again. It's just a simple, effective way to protect your money when the alarms are going off. So at the end of the day, the markets aren't just about company earnings anymore. They're a battleground for global power struggles. And understanding how all these pieces, tariffs, debt, oil, all connect, well, that's the difference between being a pawn, just getting pushed around by forces you don't understand, and being a player who can actually adapt their strategy to the new rules of the game. In this new world, knowledge isn't just power, it's your best defense.